That's going to help us set up our trading day. Let's welcome in our first guest. That's going to be Kevin Hincks, co-host of Fast Market with me. Kev, give me your take here. Relatively flat, but we've had 2 straight days of gains. Dow at record highs, S&P about 0.5% off of its record highs. What's your takeaway here?
Yeah, very hesitant start to the trading day. I think that retail sales data kind of caught the market off guard here. They were looking for numbers much higher than they got. As you know, the headline came in unchanged, 0.0. The X vehicles came in 0.0, and the X vehicles and gas all 0.0. Now, that's unchanged from last month when we had fairly strong numbers, and year over year, it's still good, solid numbers for retail sales, but this was less than expected. They were looking for numbers close to 0.4, 0.3. So a little bit of weakness there. The NFIB Small Business Optimism Index came in still above the 52-year average of 98, but less than expected. 99.3 was the NFIB. So those two numbers, I think the retail sales number was one that caught the market off guard. But Tom, frankly, markets haven't moved that much. They were up small, they were down small. They're very close to unchanged right now. So they're going to need something else to move this market, Tom.
Kevin, when you look at this, we've seen yields kind of stabilize. It's helping equities at this point. The risk on trade still going on. We were getting led in the overall markets by, maybe not the ones you want leading, but we've seen a resurgence in tech. Staples were down a little bit yesterday. We saw materials, industrials near record highs, but now we're starting to see that pivot back into tech. Is that a positive for the overall equity market? We know how much that big tech trade matters to the overall indices, right?
Well, they beat up that sector pretty well. And finally, you started coming out with some analysts making some calls in this software sector. And you saw big bounces. And Microsoft is, $20-some off its lows. Oracle bounced yesterday. So you're seeing some of the software stocks start to recover. Yields back below right now about 4.17%. I think the weak data is bringing the yields down. So, we've always been able to count on a strong U.S. consumer the last 12 to 18 months. This number, along with the weak labor market data that we got during last week, puts a little bit of pressure on yields going lower. Does it bring interest rate cuts closer to summer and midsummer? Remember, Jerome Powell's got 2 before he leaves office. Kevin Warsh will have 1 in June. So does that change the dynamic on interest rate cuts? We'll see on that. But at least right now, we've got, I think there's, the weak data that we got in the labor market, a miss on retail sales, puts a lot of focus on non-farm payrolls tomorrow morning.
Yep, and we've seen some weak data points. We saw that last week with JOLTS, ADP, weekly jobless claims rising also. So not much expectations there as far as that non-farm payrolls delayed from last Friday to tomorrow morning. Kevin, when you look at, big tech, Google, Alphabet raising about $20 billion, this makes me scratch my head a little bit. We haven't seen major tech companies do this since the mid-'90s. What's your takeaway on this? Google Alphabet's down a little bit. It's off about 7% from its all-time highs that we saw just over a week ago post-earnings. But, does this raise any concerns for you that, these big tech companies are starting to take out more debt just to kind of finance this AI build-out?
Yeah, early in the AI build-out, all these companies, Google, Alphabet, Amazon, Meta, Microsoft, they all had lots of free cash flow they can spend. Well, they're running pretty low on free cash flow. And so I think that's why you're seeing them go to the debt markets for this. Google with a 100-year bond they're floating. And it's interesting, they're floating a lot of it in sterling, in pound sterling. And why are they doing that? Well, because it says they want to do that to diversify the investor base is why they're doing that. So maybe they were worried about the U.S. markets and their ability to raise money. But remember, all these companies are going to run low on free cash flow. The rumor on after Amazon's earnings was they were going to go negative free cash flow or close to zero because their number was $200 billion in CapEx. These firms all have money. I don't know if they have unlimited amounts of money, Tom. So I would expect more and more of them to go to the debt markets for sure.
Yeah, I just wonder, the last big one out of major tech was Motorola back in the mid-90s. That didn't work out too well for that company. But that being said, rock solid balance sheet from Google, Alphabet, and earnings continue to do pretty well. All right, thanks to Kevin Hincks. He's a co-host of Fast Market here, helping us break down markets, get ready for the trading day.